Welcome to This Explainer. Today, we are systematically unpacking the mechanics and the absolutely immense risks behind the world's most dangerous investments.
We're diving straight into Jonathan T. Morgan's brilliant and terrifying guide, Flirting with Financial Oblivion. We're bringing this incredible source material directly to you, figuring out how to navigate these perilous financial peaks and, actually live to tell the tale.
But before we get into the exact nitty-gritty mechanics of these financial traps, we really have to stop and ask a fundamental question. Why do we do it? Why do investors willingly chase these high yields when ruinous risks are staring them right in the face?
To answer that, we're going on a bit of a structured financial safari. We'll start with the messy world of human psychology, then explore three very distinct habitats of extreme danger: derivatives, digital assets, and high-yield junk, before wrapping up with the exact survival tactics you need to protect your hard-earned capital.
Section 1. The Psychology of Risk. Let's make our first stop and see how our own minds are actively working against our rational judgment. So here's the crazy part. Our brains are practically wired to lead us right into danger. These cognitive traps naturally compel us to make impulsive bets. The sudden urge for a massive reward triggers pure euphoria, which completely blinds us to the downside. Then you throw in FOMO, the fear of missing out, which pressures us into rushed, sloppy decisions just because our neighbors seem to be getting rich. Combine that with overconfidence bias, where a couple of lucky trades suddenly convince you you're the next Warren Buffett, plus good old herding behavior, and you've got this toxic psychological cocktail that makes us ignore obvious, screaming red flags.
Moving on to Section 2, derivatives, options, and futures. With those psychological vulnerabilities fresh in our minds, let's step into this highly leveraged, mathematically complex arena.
Okay, picture the concept of a naked option. This is a derivative where you're betting on market direction without the safety net of actually owning the underlying asset. You are fully exposed, you are literally naked to the sudden whims of the market. It is leverage in its absolute purest, most dangerous form.
The contrast here is just staggering. With a covered option, your risk is capped because, you already own the asset you're trading against. But naked options do the exact opposite. If you sell a naked call option and that stock price suddenly skyrockets, guess what? You are legally obligated to buy that stock at the new, massive market price to fulfill your contract. And since there's no ceiling on how high a stock can technically go, naked options expose you to a terrifying, mathematically infinite loss potential. Let that sink in. Infinite loss.
We see this play out step by step in the book's completely harrowing case study of an investor named Sarah. On day 1, riding high on overconfidence, she sells naked put options on a biotech stock. But by day 15, unexpected clinical trial setbacks hit the news, and the stock completely crashes. By day 20, her losses are compounding so fast that her broker issues a massive margin call, demanding more cash right now. She doesn't have it, which brings us to day 22. Forced liquidation at absolutely terrible prices, leaving her in total financial ruin. As Morgan hammers home right here, the defining characteristic of naked options is that unlimited loss potential. Leverage in these specific markets is the ultimate double-edged sword. Sure, it magnifies your gains, but if you miscalculate even slightly, it will ruthlessly and rapidly wipe your entire portfolio off the map. If you find this analysis valuable, please like and subscribe to Knowledge Lighthouse to help us bring more truths to light. All right, Section 3, the crypto and digital frontier. Let's escape the regulated derivatives market and cross over into the totally unregulated Wild West.
Let's start with the foundation of NFTs. Value here is driven entirely by this concept of digital scarcity. It's a fascinating and, let's be honest, somewhat absurd model that intentionally limits the replication of digital files just to trigger our psychological desire for exclusivity. By proving an asset is one of a kind on a blockchain, creators manufacture rarity out of thin air in an otherwise boundless digital space. Unsurprisingly, pricing in this environment is incredibly speculative and wildly volatile.
When we impartially look at the underlying crypto networks themselves, we see some fundamental technological trade-offs that carry very distinct risks. On one hand, you've got proof of work, which is what Bitcoin uses. It secures the network brilliantly, but it carries immense environmental costs and the persistent, looming risk of a 51% network attack. On the other hand, you have proof of stake. This solves the environmental issue, sure, but it introduces complex centralization concerns, essentially risking putting all the decision-making power directly into the hands of the wealthiest token holders.
Now, beyond network mechanics, there is the massive, ever-present risk of outright fraud, especially when we talk about initial coin offerings or ICOs. If you're exploring the space, these are your giant red flashing lights. A vague or clearly plagiarized white paper, immediate warning. An anonymous team, unrealistic promises of guaranteed wealth, or aggressively rushed fundraising timelines designed solely to trigger your FOMO, walk away.
Section 4. Microcaps and Junk Bonds. We're leaving the digital frontier behind and arriving in the shadowy, lower-tier realms of high-yield debt and penny stocks. Let's tackle microcaps first, which most of us just know as penny stocks. These are companies with a market cap under $300 million. Now, they are plagued by severe liquidity challenges. That means there might not actually be enough buyers out there when you finally want to sell. This leads to something called slippage, where the execution price just drops right out from under you. Plus, thanks to their lax reporting standards and low trading volumes, these stocks are prime, incredibly easy targets for orchestrated pump and dump manipulation. And hey, it isn't just individual stocks that'll get you. High-risk exchange-traded funds carry hidden mathematical traps of their own. If you try to hold a highly leveraged ETF long-term, something called volatility decay silently, methodically eats away at your capital. Because these specific funds rebalance daily, the compounding effect during a volatile market means your long-term return is going to drastically deviate from the underlying index you actually thought you were tracking. Over on the debt side, we have ultra-high-yield bonds, or junk bonds. When you're out there chasing those juicy high coupons on risky corporate debt, your only real line of defense lies in bond covenants. This is the heavy legal fine print. Affirmative covenants force the company to provide transparent financial updates to you, while negative covenants restrict the issuer from taking reckless actions, like taking on even more debt that could tank your investment. Without ironclad covenants, you are completely flying blind. Finally, Section 5, Survival and Due Diligence. Having surveyed all these disastrous pitfalls, let's talk solutions. How do you actually survive out there? To successfully balance that risk and reward, you really have to implement structural steps to protect your capital from your own emotional reactions. First, honestly assess your true risk tolerance so you don't panic and sell during normal market volatility. Second, employ diversification as your absolute primary shield. Third, strictly utilize automated stop-loss orders to pull the emotion right out of the decision-making process. And fourth, regularly stress test your portfolio against worst-case scenarios before they actually happen. On top of that, before you make any high-risk bet, you have to conduct continuous, multi-layered due diligence. This goes way, way beyond just glancing at a quarterly balance sheet. You need to investigate the legal risks, evaluate whether the management team is actually competent, see if their strategy aligns with your personal goals, and even do technological due diligence to ensure their underlying systems are secure. So, as we wrap up this financial safari together, I want to leave you with a provocative thought. Are you truly aware of your total exposure? And have you stress-tested your portfolio's hidden risks recently? For the complete deep dive, own the paperback. Get your high-quality paperback edition on Amazon via the link in the description. Add it to your collection today. Please share this explainer and check the description for more.